This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Welcome. So when we think about healthy businesses, the owners are making money, right? So one of the reasons you own a business is to generate a healthy income for yourself. In this episode, we are going to discuss the various forms that owner compensation can take, as well as associated income tax considerations you should be aware of that impact those forms of compensation, and how to properly account for the compensation in your books and your financial statements. I'm joined again by Greg Reid, CPA and head of tax at SmartBooks, who's going to help us break down these issues. Welcome, Greg.
Thanks for having me back on.
Sure. So for purposes of this episode, let's assume that our audience is mostly owners of small businesses that are pass-through entities, so S-Corps or LLCs, where the owner compensation, where the owners control their compensation and spending decisions. And so by pass-through, we mean businesses where the taxable income of the business is reported to its owners on Form K-1, and that taxable income is included in the personal tax return of the owners. So for example, a small or mid-sized marketing agency would be a typical, LLC or S-Corp pass-through entity, right? Venture capital backed or private equity backed companies have different considerations. They may be C Corps, the owners may be different than the executives. The executives may not control exactly their compensation and spending decisions to the same extent as they would in a small, closely held business. So with that framework, Greg, let's talk about what are the primary forms of compensation that business owners can receive.
Yeah, so there's a couple of ways to get money out of your LLC. And I guess for our conversation purposes, I will say, when I say LLC, I'm referring to S-Corps and partnerships. So the first one for specifically S-Corps is W-2 wages. The second one is distributions. And then you can use some discretionary expenses and fringe benefits to effectively pull money out of the businesses and treat them as expenses. So, for example, like a home office expense, the business will reimburse you for the home office expenses, and it's a great way to get money out of the business tax-free, and you get the expense on the P&L.
Okay, so let's talk about the first form of compensation, W-2 wages. So how are W-2 wages taxed at the company level and the personal level?
So S-Corps are the only, or S-Corp owners are the only owners that can take a W-2 wage. Partners in a partnership are not technically allowed to take a W-2, even though some do. That technically is not correct in the eyes of the IRS, so something to be aware of if you are a partner in a partnership getting a W-2. And treating yourself as a W-2 employee in an S-Corp, you're going to be subject to FICA, Medicare, the same employee and employer level taxes that you would be paying, or your employees would be paying through their W-2.
So when the S-Corp or the LLC taxed as an S-Corp writes a paycheck to you as an owner of the S-Corp, right? The business pays its half of those FICA, Social Security, as well as, I forget whether it's Medicare or Medicaid, but whatever the FICA and Medicare and Medicaid tax is,
Sure.
The employer pays half of it, 6 or 7%, and then the employee pays the other half of it, another 6 or 7%, right?
Correct. And I think the FICA limit is up to, with inflation, it might be up to about $160,000 now. So once your salary exceeds that, you're just paying for Medicare, which is, I believe it's only like 2% or so on the employee side. Um, and so it's relatively small. But the FICA, which is the Social Security, can be is about 6% employee, and then 6% for the employer. So you're right, it's half and half.
So the corporation, when it pays wages, pays a corporate level tax. When you add it all up, like you said, the FICA and the Medicare, Medicaid, and then there's the various, unemployment tax at the state and federal level and other state taxes. I often will say kind of use a 9% number as the approximate ballpark payroll tax that the company will pay on wages that it pays to the employees. And then the employees have their own
And
income tax withholding and FICA, Medicare, unemployment, et cetera.
it's not an exact science, but I'd say that 9 or 10% gets you most of the way there.
Okay. Great. Well, let's talk about distributions. They may be called different things: distributions of capital, owner draws, dividends. What does that really mean, Greg? And how are distributions taxed at the company level and the personal level?
So distribution is just a withdrawal from the business bank account and a deposit into your own personal bank account. It is a balance sheet transaction, so you're going to reduce your cash, and you're also going to reduce your equity. You're pulling equity out of the business. You're essentially making the business less valuable, um, but it's a great way to pay yourself as an owner, especially as an owner of an S-Corp, because you're not subject yourself to those self-employment taxes, right? Or those payroll taxes. So and that's kind of the true benefit of being an S-Corp owner, right? So you pay yourself a fair salary, which we'll get into later, but then the balance of that, of what you need to live off of, or what you want to pull out of the business, comes out as a distribution, owner draw. I don't like the word dividends. People do use it, but it does have a technically it has a different meaning. And all those distributions that you take out are, again, just pulling equity out of the business and not subject to the payroll taxes.
Right, right. It's a non-taxable event for the company as well as the individual. Although, if you think about it, the only way you're really going to be able to take distributions most of the time is if the business has accumulated profit. And so there is some tax to pay, but it's based on the taxable profit of
There's
the
things to
business, not the
consider.
distribution amount, right?
Yeah, there's definitely things to consider when you're pulling a distribution out. If you are not a profitable company, like you alluded to, if there's no cash there, then you can't pull money out. You also probably wouldn't be able to pay yourself a W-2 wage, but you have to be careful of basis, and basis is your personal equity in the business. Um, Without getting into too much detail, it's essentially what your equity is in the business. And so if your equity in the business is $50,000 and you want to pull out 60, then the differential there, the 10,000, is going to be treated as technically a dividend and subject to tax as a dividend.
Right. So, in order to be able to pay a distribution in excess of what you've previously invested in the business and the profit that's accumulated in the business, right? In limited ways that's possible. It is possible, though, if you were to borrow money, say you drew down your line of credit from the bank and you borrowed $100,000 from the bank and then you paid yourself a $100,000 distribution, you could effectively borrow in order to pay yourself a distribution. Or maybe you've got a business model where customers pay you an advance deposit of some kind of advance payment, before you've delivered any goods or services. So, effectively you can borrow from a lender or from customers to raise cash and distribute some of that out of the business. But then you risk running afoul of
You could run into
dividend tax that you mentioned, and you may drain the company of needed capital at the same time.
yeah, and you can get into stock basis and debt basis and stuff like that. And that's why you really need to have a CPA on hand that really understands what these terms mean and how they interact with each other, because otherwise you could end up getting into a lot of trouble down the road.
Right. So, and let's talk briefly about the third form of compensation, discretionary expenses and fringe benefits. I know this can be a rabbit hole, especially when it comes to fringe benefits, because the taxability and applicability of certain benefits really varies by entity type, whether it's an S-Corp, C-Corp, LLC, partnership, et cetera, et cetera. We did you and I, Greg, I think last summer in episode 3 of the podcast, we went into some detail about, some top tactics that small business owners can use to reduce their taxes. And a lot of that was focused on different forms of discretionary expenses and fringe benefits. But could you just kind of summarize, how small business owners should think about discretionary expenses and fringe benefits in the context of owner compensation?
Absolutely. So I like to say that you're basically submitting an expense report to the business and getting reimbursed for those expenses. Once you submit that expense report, the expense goes on the P&L of the business, and then you get reimbursed and effectively made whole. My favorite one is the home office expense, especially post COVID, everyone's working from home, and this has become kind of a given with most of my clients, that we just automatically take the home office expense, especially for our clients that are kind of in the digital realm that are only working, remotely. And you're effectively taking the portion of your home that you use for your home office, and you're applying certain expenses that you would have paid anyways. So, say like electricity. Say you take 10% of your electric bill, submit it as an expense to the business. It becomes an expense on the business, and you get made whole. So maybe it's a $50 a month, or a $20 a month expense. These all add up. Again, we went through a lot of these on that past podcast, and so I don't think we need to dive into it too much. But definitely, I would say these discretionary expenses and fringe benefits is where, if you have a proactive CPA, you can start to see some solid tax savings opportunities on a year-over-year basis.
Okay. I mean, I would think that might be the first form of compensation to think about is how do you maximize, discretionary business expenses? Because those would be fully deductible to the business, right? And non-taxable to the employee, right?
Yeah, and just as long as you're keeping good records and staying within your means for does it jive? You can't say that your whole house is a home office, but 10 to 20%, that makes a lot of sense. Um, and it can be a great way to essentially take those personal expenses that you're already paying and make them tax deductible.
Right. And it doesn't matter the entity type, right? A partnership, an S corp, a C corp, they can all reimburse you
Oh yeah,
for
they
the
can all
cost of
they can all
running the business
reimburse.
from
Yep.
home. Okay. And so, when you're just starting out in business, you're probably relatively small, not making a lot of income. It might not really matter that much, the entity selection. If the business can only afford to pay you $40,000 a year, it might not matter that much whether you're an LLC or an S corp or C corp, right? But at a certain point, the numbers get bigger and more significant. So, what would you say, Greg, about entity selection when it comes to compensation, and which entities and forms of compensation might be more tax advantaged than others?
Yeah, that's a great question. So there is, and it kind of depends on the industry, and how much your compensation would be for your specific job. but there's typically a threshold where it makes sense to go from either a single member LLC, what we would consider like a Schedule C on your individual income tax return, or a partnership, to electing S-Corp. And the reason for that is because your single member LLC on your personal tax return or your partnership, all that income that passes through to you and that you pay at the individual level is going to be subject to self-employment taxes. Effectively, all self-employment taxes are payroll taxes, but it's the both the employer and employee side of it. So you're looking at about 15.3% of whatever you earn being taxed in addition to the income taxes. And what happens is a lot of people will say, oh, you know what, I'll just assume 25% of whatever I earn is subject to tax. It's a good number. It'll get me most of the way there. And then all of a sudden prepare the tax return, and they're like, well, why do I have all this extra tax on my tax return? And it's because of the self-employment taxes. Now, like again, I said there was a threshold. So at 30 or 40,000, it's not a huge number, and it probably doesn't make sense. And I say 30 or 40,000 of bottom line net income, right? It probably doesn't make a ton of sense to convert to an S-Corp, potentially create another filing, another fee that you have to pay your CPA to prepare a return, set up payroll, run payroll, go through all that headache, just to save what might only be, a couple $1,000s. But to your point, if now we're hitting, maybe 70, 80,000 in bottom line net income, it might make sense to convert to an S-Corp, pay yourself a salary of, call it 40,000, 50,000, and then pull out the remainder of what you need to live off of, say another 10, 15,000 as a distribution. You're effectively saving 15% on that 10, 15, 20,000 that you're pulling out of the business over and above the wages that you're paying yourself. And as you go from, say, that 50 or 60,000 of wages, that up to the FICA limit, right? That's where you maximize the tax savings as an S-Corp owner.
Okay. And so it would be very tempting, it sounds like, if I'm an S-Corp owner, to pay myself a very low salary because all the extra distributions would not be subject to self-employment tax, right? But that sounds too good to be true. So what do we need to worry about there?
It would be very tempting, and sometimes it is a little too tempting for some business owners. The IRS is on to us. They agree that this is a legal way to pay yourself and pull money out of the business, but you cannot treat yourself as an S-Corp and pay yourself $12,000 a year as a CEO of a business. You have to pay yourself what the IRS loosely defines as a fair salary. Now, the tax code does not specifically define how to come up with a fair salary, what a fair salary is. There's no percentages. There are some industry standards that I've used, and there's kind of different levels on how to come up with that salary. So I think a lot of CPAs will use a 60-40 split. 60% go of whatever your take home needs to be. Let's just say 100,000. So 60,000 would be your wages, 40,000 would be your distributions. Does that make sense? It again depends on what you do. You can get super detailed. There are programs out there that will kind of walk you through, a list of like a questionnaire and say, what do you do for the business? How much time do you spend doing each activity? Maybe, to the point where they're like, are you doing, janitorial sort services versus CEO level services, right? Obviously, those two areas are going to get paid a different salary. So it takes all that into consideration. It takes into consideration your geographic location, and it'll spit out basically an audit-proof summary of what you should pay yourself. In my experience, what I've seen is if you have a good CPA, they can pretty accurately come up with what a fair salary is. A lot of people, you kind of know what it would be, right? And you can try to cheat it and go super low, but eventually, you'll probably get whacked.
Right. So let's talk about the business that has grown and become significantly more profitable. Where instead of talking about $50 or $100,000 of annual owner comp, we're talking about 250,000 or 500,000 or $1 million or more, right? So what's the FICA threshold these days?
Let's call it 160 for now, although I think that's just a round number. Uh,
Okay.
it
So
increases with inflation every year, so.
so if you've got a larger business, it's going to be, and you're the CEO, and the business is doing $500,000 or more in annual profit. It's going to be very hard for you to justify a salary, significantly lower than that FICA threshold, right? And so then
Yeah,
you're really looking at self-employment tax of the 2.9% or so on the Medicare and Medicaid to worry about, which
there's
at
a lot.
smaller salary levels isn't very meaningful. But if you're talking about $500,000 of taxable income, 3% of that is $15,000. So you start to worry about the Medicare Medicaid portion of the payroll tax, right?
Yep. Yeah, I mean, it's again, there's a lot of diminishing returns here. Once you get over that FICA limit, it becomes less advantageous. But it is still, if someone handed you $15,000, would you say no to it? Probably not. I certainly wouldn't. And so, um, it's still a tax benefit, just not a huge tax benefit. And again, it really depends on a lot of it depends on your geographic location. Maybe some of the southern states, 125,000 could be a fair salary, and now you've got that, $30,000, $40,000 gap between 125 to 160 that you're getting kind of the maximum benefit on.
Okay, makes sense. Um, let's, so let's talk a little bit more about fringe benefits, right? Like what are the top several types of fringe benefits that you see, and how are those subject to tax? What do you need to provide your CPA so the CPA can incorporate them properly into your tax return?
Yeah, I think the biggest one would be like health insurance, which can get a little dicey. I think fringe benefits in general, especially for S-Corp shareholders or S-Corp owners, can get can certainly get tricky, and certainly something that you want to discuss with your CPA. So, for example, I mentioned health insurance premiums. those technically aren't deductible from for a greater than 2% shareholder. And so you have to make sure you set up your payroll correctly, and you have to make sure that you're preparing your individual income tax return correctly to take advantage of those deductions if you can, at the individual level.
Right. All right. So we're talking a lot about how owner compensation is taxed, especially between the different entity types. I'd like to talk a little bit about a related topic, which is how owner compensation is accounted for. How do you bookkeep it? How do you book it in QuickBooks? Where does it get reported in your monthly financial statements? Right. And I think before we dig into that particular topic, I think there's a kind of a contextual issue around book tax differences we need to understand. So I come at things from more of a management reporting perspective where I want the owners and executives of the business to have as accurate as possible, a snapshot of how the business is performing financially so they can use that information to make management decisions. And I'm I tend to devalue the tax return because I think, well, yeah, you have to file the tax return at the end of the year, and I know a lot of work and skill goes into the tax side of it, but I really care first and foremost about running a nicely profitable business, and then I'll let the tax project figure out how that needs to get reported to the IRS. But I know inevitably there's some differences between priorities of managers in management reporting and priorities of owners when it comes to their taxes and their CPAs and helping them plan and file their taxes, right? So, what is this concept of book tax differences, and where does it often arise?
So I think what you typically would like to see is if an owner is going to pay themselves or needs, let's just say they need, $150,000 to live off of, you want to see the 150 on the P&L or the income statement, so you can accurately show, okay, here's your monthly net income, here's your available cash. It provides a much cleaner snapshot. Otherwise, from a technical tax standpoint, you're only going to deduct your W-2 wages from the income statement, and any distributions are going to be a draw from equity on the balance sheet. And at a given snapshot throughout the year, you might not necessarily really appreciate where you are financially as a business owner. Your P&L might look awesome, but if you're taking a ton of distributions out of equity, then your business might not be doing that great from a cash flow perspective. And I think those are the book to tax differences that we, as tax preparers and accountants, need to make sure that we just communicate to each other. I know you and I have gone back and forth on how these get reported and where they get reported. And I've always said, if you want to put distributions throughout the year on the income statement, although technically not correct,
From a tax perspective.
from a tax perspective, if you're going to do it, make it a separate line item and put flashing red lights around it and warning signs, and just so that when the CPA gets the books, they know, okay, I see what the accountants did here and I understand why they did it, but let's make it correct in the eyes of the IRS, right? Or I guess you could argue GAAP as well, but we're not necessarily following GAAP for all our clients.
So let's talk through an example to help crystallize this for the audience. Let's say we've got a business doing $1 million in annual revenue, and the owner's taking $150,000 distribution or draw, whatever they call it, distribution in a partnership in an entity like an LLC that's filing as a partnership. And so we got $1 million of revenue, $150,000 of distribution. And so why this really matters is, let's say the $150,000 in QuickBooks is reported as an equity distribution like it would be on the tax return. So we've got $1 million of revenue, and say QuickBooks says at the bottom of the P&L a profit of $100,000 for the year. Now, looking at that, you might say, oh, great, on $1 million of revenue, I got $100,000 of profit. I made a 10% profit margin. That's pretty good. Life is good. I've got a nice profitable business. But what about that $150,000 of distribution that you got paid for being the CEO of the company, that you would have to pay somebody else to do if you were not the CEO of the company? So there's kind of $150,000 of operating expense that appears nowhere on the P&L. But let's say we took the alternative approach, and we booked the distributions as an expense on the P&L, and we used a separate account in the chart of accounts. We highlighted it in yellow when we communicated it to the CPA. We highlighted it. But let's say we look at that P&L now. We've got $1 million of revenue, and we subtract out the $150,000 of owner distribution. Now, instead of having a positive $100,000 at the bottom of the P&L and feeling happy like we made a 10% profit margin, we're going to have negative $50,000 at the bottom of the P&L, and we're going to be unhappy because we lost money and we've got a negative 5% profit margin. And so that's why it really matters for management reporting is, what's the real operating expense and P&L of the business, not just what does the tax return say. So that's why this really matters.
And if you're an accountant and you're doing this, you would look like an absolute rock star if you turned around and said, well, maybe we have some basis issues that you should be talking with your CPA about, because if you're at negative 50,000 with the owner's comp, then you're effectively pulling out more equity from the business than potentially you have, and you could run into basis issues. So, little thing for the accountants out there that could, make yourselves look like absolute rock stars.
Great, good tip.
CPA would appreciate it.
All right, so however you've chosen to account for owner compensation, and however you've chosen to get the cash out of the business, you're going to have a tax bill to pay at the end of the year, assuming the business had some taxable profit, right? And so the nightmare scenario is the small business owner gets to April, gets the tax return from their CPA, and sees they owe a lot of money to the IRS and their state government, and they don't have any cash to pay those tax bills. That's a nightmare, right? So how do we avoid not having the cash on hand to pay tax bills?
This is where proper tax planning comes into place and why you should be talking to your CPA throughout the year. So effectively, you're right. Nightmare scenario is you've pulled out all this money from a distribution. The balance or the income statement looks awesome. You're like, that's great, but I don't have this much money in my business right now. And it's essentially because you pulled it out and paid yourself and, either put it in your own personal savings or went out and bought a new car or a new boat or something like that. And now you've got this big tax bill and you don't have the cash to pay it. Unfortunately, this does happen. And it really is a result of not fully understanding your financial statements and not having those conversations with your CPA throughout the year. So I always say that if having a W-2 and distribution breakout is part of the plan, that's great. But on a monthly basis or a quarterly basis, you want to make sure that before you take that distribution, you're also factoring in how much needs to be kind of put aside for taxes. And so, for example, if you're like, all right, every month I'm going to take $12,000 in a salary, and I'm going to take $8,000 in a distribution, then you want to make sure that part of that eight is um, is put aside for taxes effectively, or that you have available cash on hand to pay for taxes, either quarterly or at or come tax time. So that is something that we will do with our clients throughout the year, is just kind of talk with them and make sure that not only are they paying themselves a fair salary and a fair distribution, but they're also factoring in, okay, I am going to need to put this money aside for taxes, and making sure that they have that adequately calculated.
So effectively, when taking a distribution, you earmark the first X dollars toward taxes, and then what's left over is net take home that you can go spend
Yeah,
on that
I mean,
car or boat, right?
effectively, yes. It's not, again, not an exact science, but that's typically how the scenario works.
Then the other way we, sometimes see clients tackle this challenge is they put aside a certain percentage of the business's profit into a separate dedicated bank account. So they work with their CPA, like you, to figure out what their projected tax bill is going to be for the year, and then say, it kind of works out that they're going to owe about 30% of the company's profit to the IRS. And so, every month, every quarter, they'll take 30% of the profit and transfer it from the operating checking account to a tax savings account, hopefully earning a little bit of interest. And so they're effectively saving that money and earmarking it so it's available to pay taxes later. And maybe they pay their quarterly estimated tax payments out of that separate bank account. Or if they, for whatever reason, don't want to make quarterly estimated tax payments, then they're just going to be accumulating that cash, earning interest on it over the course of the year, and then it will be available there in March or April when they need to pay their taxes.
Yeah, that's a completely different tax strategy, but essentially, yes, pulling it, putting it aside, paying it either quarterly or at one time, depending on underpayment penalties and how that all factors in. But yeah, that would be the way that ideally it comes out. And ideally, you're putting money aside every month, and then at the end of the quarter, you have that money to go ahead and make that tax payment.
Right. And practitioners of the profit first method, like we talked about in episode 14 with Rocky Lalvani, putting profit first, they'd even go so far as to create an additional bank account dedicated to taxes separate from profit. Right. And so they just
Yep.
transfer whatever the estimated tax liability is going to be into that tax bank account and hold it in a dedicated tax bank account. The pros and cons, there's only so many bank accounts you want to be managing and moving cash between, but that is another approach as well, to have a dedicated bank account just for taxes.
Yeah, it's one way to do it.
Um, all right, Greg. So this can get complicated, right? So what do you see as some of the larger pitfalls or problems related to owner compensation with clients that you work with or start engaging with as a new tax client for your practice?
Yeah, so a couple of the bigger ones, is that I always tell, especially my older clients, that if you pay yourself a lower compensation, then that could negatively affect how much you get with from Social Security when you go to retire. Some clients don't care about that because they're already financially secure, but other clients, it is something that they need to factor in. So just be aware that if you're gonna essentially like lowball the wages, that is going to impact your Social Security, or could potentially impact your Social Security in a negative way, and reduce that amount. The other one is a lot of times owners will assume that whatever they're withholding from their owner's compensation, so on their W-2s, is going to cover all of their taxes. That's definitely not the case unless you are withholding at like a 70% rate. It's really just going to cover whatever your wages are. So if you're paying yourself $60,000 and you're withholding, you just pick your standard, married filing joint with one, dependent, or a single zero, or something like that. It's just basically going to withhold as if you were a regular, W-2 employee working for another business. So don't assume that you're just everything you pay in through your payroll is going to cover all of your taxes. We have to consider the net income, that we just alluded to a few minutes ago.
Okay. And if there's one single thing that a small business owner can do to keep their CPA happy when it comes to owner compensation practices, what would that be?
Don't pay yourself a low amount. don't try to convince your CPA that you only are worth $12,000 a year, because I've had clients try to lowball me, and it's just not it doesn't create a great relationship, and it could certainly bury you in the future if the IRS were to come in and say, that's great, but we're going to take all these distributions that you paid yourself and we're going to basically convert them to a salary, and now you owe us not only payroll taxes but all the penalties and interest associated with it. Not necessarily a fun conversation to have.
Right, right. So if I reflect back on this conversation, um, it seems pretty clear that the form of owner compensation is directly tied to important legal entity selection decisions and potential election decisions that are made with the IRS for how LLCs would be taxed, and needs to be considered in the context of the overall individual and family income and tax picture, not just the business itself or a single owner, right? And so I think this conversation just reinforces the importance of working with a more proactive CPA who can help put together a plan that takes all these factors into consideration and helps you make decisions that align with what your tax and financial objectives are.
Yeah, absolutely. I think that if you're just a single member LLC right now, and business is continuing to grow, then it's probably going to make a lot of sense to bring in a professional if you don't already have one, sooner than later, just so you can maximize any tax savings opportunities and avoid any pitfalls.
Great. Well, Greg, thank you so much for coming on the podcast again and sharing this valuable information for the audience. If folks want to follow up with you directly, what's the best way for them to get in touch with you?
So you can reach out to me via email. Greid at smartbookstax.com is probably the best way to get a hold of me. You can visit our website, smartbookstax.com, and there's a link there to set up an appointment with me via my calendar link. So you can set up a time that's convenient for you to chat. Those are probably the two best ways to get in contact with me. And hopefully we can help you out with any tax savings.
Well, great. Thanks, Greg. Look forward to having you back again when we can find another riveting tax topic to discuss.
They're all riveting, right?
That is true.
All
All right.
right,
Take care.
thank you.
All right, that was pretty good. Probably won't require.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.